Hey everyone, and welcome to The Explainer. Today, we're diving into a really fascinating story that's playing out right now in the automotive aftermarket sector. We're going to completely deconstruct the Q1 2026 earnings of Dorman products. Now, if you're not familiar, they're a major supplier of replacement and upgrade parts for motor vehicles. But what makes this specific quarter so incredibly compelling to look at is the intense friction between their top line and their bottom line. It's a classic business narrative, really. You've got strong, resilient revenue growth just going absolutely head-to-head with some pretty severe macroeconomic headwinds that are squeezing their profits. If you've ever wanted to understand how a massive manufacturing business actually navigates global friction while still pushing product out the door, well, this is the perfect case study.
Okay, let's quickly map out where we're headed today. We'll start by looking at the auto aftermarket engine. Then we'll review the actual Q1 2026 financial results. After that, we'll unpack those market headwinds we mentioned, look at their cash flow and buybacks, and finally, we'll wrap up with the road ahead.
Section 1. The auto aftermarket engine, solving real-world problems. So before we even look at a single financial ratio, we have to understand the actual physical products this company makes. It really begs the question, how exactly does a company keep growing its top line while facing major macroeconomic storms and global supply chain shifts? For Dorman, it really just comes down to everyday utility. You know, vehicle maintenance isn't optional for most people. It's an absolute necessity. Let's look at how they maintain that operational momentum on the ground.
Dorman isn't just sitting back and coasting on their legacy catalog. No way. They are aggressively expanding. Just in this first quarter alone, they launched over 400 new parts. That includes 130 aftermarket exclusives covering everything from traditional gas engines to EVs and hybrids. But take their new upgraded heater hose, for example. The original equipment on 2015 to 2017 F-150s used these plastic connectors that notoriously cracked and leaked. It was a huge pain. So Dorman engineered a fix using a highly durable aluminum connector to permanently solve that headache for 500,000 truck owners. They don't just replace a part, they engineer a better one.
Moving right along to Section 2, Q1 2026 financial results, the top-line success.
All right, let's shift from the garage to the balance sheet. To do that, we're pulling data straight from the source, bypassing all the PR spin. This is Dorman's official Form 10-Q, filed with the SEC for the quarter ending March 28, 2026. This is the raw, audited data that management handed over to the government and their shareholders. Let's see how those new products translated into revenue.
So look at this top line. It's incredibly healthy. Net sales for Q1 2026 hit $528.8 million. That's a really solid 4.2% increase compared to the exact same quarter last year. And honestly, this proves our earlier point. Despite broader economic uncertainties, the demand for aftermarket car parts, especially those cleverly engineered fixes we were just talking about, it remains totally robust. People are holding on to their cars longer and they need parts to keep them running. The revenue engine is absolutely humming.
Section 3. Navigating market headwinds, the margin conflict. Okay, so if revenue is up, why did the bottom line take a hit? To cut through the financial jargon, we need to look at adjusted diluted EPS. Think of it like judging a car's regular fuel efficiency rather than just looking at a trip where you coasted downhill the whole way. It gives us a cleaner view of their standard ongoing earnings power. And for Q1, that adjusted EPS came in at $1.57. That is a 22% drop from the previous year. So, Dorman is down 22% per share even as revenue climbed. Where did the money go?
Let's move to the segments and see how this builds. This breakdown shows the hit across their three main areas. Light duty is their massive core business. It brought in nearly $424 million in sales, up 4%. But look closely at that profit margin. It plunged by 580 basis points, dropping down to 14.1%. Meanwhile, heavy duty saw incredible 12% sales growth and actually expanded its margins slightly, while specialty vehicles just stayed flat. But because light duty makes up the vast majority of their sales, that specific margin drop effectively dragged down the entire company's earnings.
So what caused that 580 basis point drop? Well, the primary culprit is purely geopolitical. Dorman sources about 77% of its total product volume from outside the United States, with 38% coming specifically from suppliers in China. Throughout 2025, new tariffs were enacted, and those significantly jacked up the cost of importing those raw materials and finished parts. So Dorman is selling more products than ever, sure, but it is costing them significantly more to acquire those products, squeezing that profit margin right in the middle. It's literally a textbook example of global trade policies directly hitting a company's financial statements.
Section 4. Cash flow and buybacks. Management's response.
Now here's where things get really interesting. Despite that earnings drop on paper, the actual cash engine of this business remains incredibly stable and healthy. In Q1, Dorman generated $43.8 million in pure cash from operating activities. How? Well, they strategically reduced their inventory levels, basically turning parts sitting on shelves into cash in the bank. And they benefited from lower factoring costs. Plus, their capital expenditures were only $8.4 million. That leaves them with a very comfortable pile of free cash flow. Operationally, they are rock solid.
And here is exactly how they decided to deploy a massive chunk of that cash. $51 million. Let that sink in for a second. That is the amount Dorman spent in just the first quarter to buy back their own stock. They repurchased over 435,000 shares at an average price of roughly $118 per share. Listen, when a company's board authorizes $51 million to buy back their own stock during a quarter where profit margins are actively being squeezed, it is a massive, flashing signal of confidence. They clearly believe the broader market is undervaluing their shares and that these tariff headwinds are either temporary or, at the very least, completely manageable in the long run.
Which brings us to Section 5, the road ahead, looking to the horizon.
So what does this Q1 data mean for the rest of 2026? Well, despite taking that hit on margins in the first 3 months, management is standing their ground. They officially reaffirmed their full-year guidance. They're still expecting net sales to grow between 7% and 9% over 2025, and they are projecting a full-year adjusted EPS between $8.10 and $8.50. This is absolutely crucial to note because it tells us they had already anticipated these tariff impacts when they built their forecasts. They firmly believe their ongoing cost-saving initiatives and supplier diversification are going to allow them to absorb these shocks and still hit their annual targets.
CEO Kevin Olson really hit the nail on the head with this statement. He says they remain confident in their strategy and position as the innovation leader, and that they'll continue to execute on the factors within their control to support long-term growth. And that's the key phrase, within their control. They can't control global tariffs, but they can control their supply chain efficiency, their new product launches, like that awesome aluminum F-150 fix, and their share count through buybacks. They are focusing relentlessly on the controllables. And Wall Street is definitely paying attention to this strategy. Despite the macro friction, the consensus rating from institutional analysts remains a strong buy. Big firms like Barrington Research and Jefferies have set price targets ranging from $140 to $150 per share. So the institutional money seems to completely agree with Dorman's board. The underlying business of solving real-world automotive problems is highly lucrative, and the current margin pressures just aren't enough to derail the long-term thesis. Which leaves us with this final, provocative thought to ponder. Dorman is currently trading at a forward price-to-earnings ratio of roughly 13.6. That is relatively modest for a company with this kind of cash generation and dominant market position. Combine that multiple with their aggressive $51 million share repurchase program, and you really have to ask yourself, has the market mispriced a fundamentally solid, cash-generating manufacturer simply because of a temporary margin squeeze? It's a truly fascinating dynamic between global macroeconomics and targeted, everyday utility. Thank you so much for joining me for this explanation, and as always, keep your eyes on the data.